Hey, what's up, guys? Sam here, and I'll be doing the premium video for Friday, March 7th, 2025. So another week is in the books, and it was certainly a pretty wild one. If you like volatility, this was your week. So let's start with where we were last Friday, right? I only get to talk to you guys in these videos once a week, so lots has happened between last Friday and this Friday. Last Friday we went into the weekend and we had this kind of attempted a bull trap here at 590 on SPY. Basically, a bull trap being you have this previous support level here, right, from that recent low, stretch it across. You traded below it on Thursday right here, and then on Friday you went back above the 590 level and essentially created a trap. Why is that so important? Well, it's so important because this is like the number one move that bulls and bears use against each other to get momentum going. You can think of it kind of as a momentum ignition pattern, right? So here's one that's already played out. This is the previous high, left to right. You trade above it, and then once you trade below it, that creates a bear trap, right? So it's the inverse of what we're talking about now. That creates the bear trap, that little pop above, failure back below dynamic. And so this was in play as of last Friday at 590 being the strike that needed to hold. And then we come into the week and Monday is just an absolute bloodbath, right? So immediately within basically just over the weekend and on Monday, they broke the pattern. And guess what happens? If you break the pattern, it's an if this then that. You then have to tangle or tango at the previous lows. So that previous low comes in roughly at 575. And you'll see that, again, if we use that even more major low, right, because this would be a minor low, this would be a major low. If we use that level, 575, we stretch it across, what has happened? Well, an identical pattern. You have the break below, and then you have the big candle closing near the highs, retaking the level, right? So you can see the break below, the big candle retaking the level. And to add a little bit of spice to the setup, it's happening across the daily 200, which is a very strong level of support. A lot of folks are going to be looking at that. A lot of institutional folks are going to be looking at that and saying, hey, the market is now cheap enough to buy it. Let's go ahead and try to buy it here. So we're going into the weekend, very similar dynamics to what we had last weekend. However, the scores have actually significantly changed. So again, it's going to be an if this then that, right? The way that I'm going to look to play it is as long as the market holds 575 or higher, then you actually have a potential to retest this previous support, now resistance at 590. But it absolutely has to hold 575 on a daily closing candle. I don't care if it like goes down below and then closes above again, something like that. That's acceptable. Just on a daily close, it has to hold 575 in order for this bull trap attempt number 2 to remain active. The problem is that in doing so, they've actually kind of, they've lost a lot of ground in terms of the indicators, right? Last week, if you recall, the SPY was a neutral. It was slightly negative, but it was just neutral. And as we're going into the weekend here, it is a bearish setup. The momentum is bad, and the structure has taken a hit. You can see here on the high-low, just nothing but sell signals basically since there, and you don't yet have a turn signal. So interesting dynamic because they're trying to do the bull trap again. This probably should say bear trap actually. That's actually more accurate. It should say bear trap. And they're doing it across a stronger level, but they're doing it with weaker momentum. So what does that mean to me? Well, one, like I said, 575, in my opinion, needs to hold on a daily closing basis in order for this pattern to remain true. I think you're going to have stops above that wick. I think you're going to have a ton more stops above that wick. And then you're going to have a lot of sellers up here at 590, I would imagine. Here's one thing that I do want to point out, though, and that is over here on the weekly chart. Now, the weekly chart was bullish last week, and it's still okay, right? The setup still very much aligned for a bullish move. The only issue here is momentum. And so essentially when you have an issue with momentum but no issues with structure being the overall positioning of price relative to the moving averages, then you need to create a short squeeze. So next week based on everything that I'm seeing here, it looks like they're going to have to try to create a short squeeze off of these levels in order to reignite the momentum. It's not going to be easy though, and I want to show you why. Before, when you've had kind of retests of the cloud, I want you to look at the lower indicator there and tell me what's the difference between then and now. And the difference between then and now, those three tests, this would be the fourth right here, is that under these previous 1, 2, 3 circles, the trend oscillator was always green. See it? Basically, it kicked off, it gave a very nice signal here. If you see the alignment, see that pretty alignment there? So it gave a great signal, and even on pullbacks, the signal held, and it gave you kind of a tailwind for buying inside the weekly cloud. The weekly cloud is just the weekly 21 and the weekly 50. This time, however, we're doing the same thing, where normally it would be just a straight up buy, and maybe, you know, maybe it reverses here, and that was all she wrote, and she just needed to come back down to hit the 200. But it is a different animal here than before, and the reason is pretty straightforward. You have your first down arrows. You did not have down arrows here, or here, or here, right? And so what do we have? Well, we have kind of the opposite signal. We had a very good long signal there that obviously went forever, and now you kind of have the opposite signal, right? You see how the alignment there, all the arrows are pointing down, you have the squeeze forming. So I'm not overly enthusiastic about it. You know, I certainly would not mind seeing a short squeeze. I think pretty much even if you're bearish, you probably want to see a short squeeze just so you can get another shot at 590 as a short. You know, basically getting all the oversold conditions to relieve to the upside and then jumping in short. But there's really no way that I'd be able to trade this long for a swing trade. In a swing trade, I'm just loosely qualifying as, let's say, 7 to 10 days, right? You know, up to, you know, let's say 5 to 10 days. So like 1 to 2 trading weeks, essentially. I don't see that potential in it quite just yet, but understanding that the volatility is elevated, understanding the ranges are elevated, it remains a very good day trader's market with a lean towards the bear side. Let me show you this chart next. I was going to save it until the end, but I'm going to show it to you here one more time. For those of you in the room, you've already seen it. For those of you that are not in the room, I just want you to see it as well. And so this is the Mag 7 index. Probably needs a better name, but that's what I just call it, the Mag 7 index. It has Apple, Amazon, Google, JP Morgan, Meta, Microsoft, Netflix, Nvidia, Tesla, and Taiwan Semi. So collectively there's about, I think, around $15 trillion worth of market cap just reflected in this chart. So what do you see with the lower indicator here? Well, hopefully you just see the signal. You have arrows, arrows, and arrows. So let's just see what they meant. You had arrows here that kicked off right about here, and that took you down for almost a year. That's pretty impressive, right? No false signals the whole way, and then you get a signal shift here, right? And so that happened there. And what happened after that? Well, that was even more impressive. It's taking you all the way up here. And now what do we have now? Well, we have the same signal, just in reverse, right? And so I wanted to show you this one because it's $15 trillion worth of market cap, and where this chart goes, the broader indexes will follow. And then two, just because of the cleanliness and the accuracy of the signal on this chart, it's a little bit difficult to deny it, right? It's not like it has 100 different crossovers and I'm choosing this one or that one. There's only 3 crossovers over the last 3 years, and they've all been significant moves. So keep that in the back of your mind. It will be kind of something that weighs on me as well. You know, going into next week, my plan personally is just going to be to focus on very short-term trades. I got my butt kicked on swing trades through March, and I thought I was actually in some pretty decent stuff. Like, my biggest position was utilities, and it had been that way for about 2 weeks. Normally, if you tell me that the market's going to crash, led by tech, I would tell you that there would be a couple places that might do well. One would be utilities. 2 would be staples, maybe some real estate, and then bonds, right? And I was in the utility space, and I still got my butt kicked. So as a swing trade, meaning, you know, I was trying to hold it for longer than a week or two. So what does that tell me? Well, it tells me that all my recent successful trades have been very short term, right? It's been one day to the next, or even the same day trades, but oftentimes it's just one day to the next. The signals that I'm showing you here, the reason I'm spending so much time on SPY is so that we don't have to spend as much time when we look at other things, because we can just take the SPY work and work off of that. But I'm not seeing anything here that would justify being swing long, and I don't necessarily love this as an entry for a swing short. The last thing I'll say about this chart is be very careful, because now you do have a weekly squeeze. And you have a weekly squeeze that's occurring in a negative orientation on the daily and alignment between squeeze and arrows on the weekly that mirrors when the market went up years ago. So what the interesting part about that is, regardless of whether you want to be bullish or bearish here, you probably want a bounce. Bulls want a bounce so that they can reverse the thing higher, and bears want a bounce so they can short it from higher prices. So here on the QQQ, a little bit of a sloppier picture. A little bit sloppier. For this one to have a trap, an actual trap, I would have to be a little bit liberal with it. And I don't necessarily want to do that, because essentially this one, in my opinion, probably should have held the trap, although getting all the indexes down to their daily 200s is probably very important. But the trap last week was right there across 500, right? And then of course, to start the week, you know, it opened up very, very nicely, hit 510, and then just drills, breaks the low, breaks 500, and now we find ourselves down here kind of tangling with the 200 daily. On this one, I'm not going to be able to give you a trap level. I think basically it becomes somewhat straightforward that I think this is unstable below 500, right? So keep in mind that let's just be crazy and say that we're going into a bear market here. You know, I don't know how much I want to put that out into the universe, but let's just be nuts with the idea, hypothetically. If we are going into a bear market, bear markets happen to have the biggest counter trend rallies, right? So you'll get huge rallies in bear markets, but they'll end up making lower highs. And so with the Qs here, I see it as an unstable structure unless it gets to 500 again and basically creates a giant trap, right? Getting back price above the X, and then from there they can start to do some work to the upside if they so please. Let's go to the DIA real quick. I haven't looked at this guy. And the DIA continues to be the strongest one, at least in the interim. It's still the strongest one. Okay, so I would say this: the level on SPY was 575, and that one is an active bear trap at the moment. It doesn't mean it works. We could come in on Monday and this thing gets body slammed, much like last Monday. But even if it does that, it gives you immediate clues, because you know that if it breaks 575 to the downside, you don't have to wait for the lows, in my opinion. You don't have to wait for the lows to break. If it breaks 575 on a daily closing basis, it's probably going to continue going lower. If they're able to hold 575 on a closing basis on SPY, then we can look for that retest of 590. And of course, simultaneously, we would look for a retest of 500 on the QQQ. And there's a lot going on here, so bear with me, if both SPY and QQQ get above their trap levels from last week, then we have an ugly, choppy, yet stable market. What are the levels? The level from last week would be 590 on SPY, and the level for the Qs would have to be 500. Okay, so hopefully all that makes sense in terms of how to look at it. And if any of this does not happen, the opposite will happen in a rather dramatic and swift way. So it's an if this then that. Let's jump over to a couple of other things here. I just really want to spend a lot more time on SPY than usual, just because I think that's really kind of where everything, the rubber meets the road kind of thing. Junk bonds have decreased in quality here. They're not really anything at this point. This could go either way. I would have to say it still has to have a bullish bias, primarily because the weekly chart is still bullish and the weekly squeeze histogram is still bullish. I suggest kind of following HYG, just, casually, if nothing else, just because if markets are really going to get into trouble, this should be making lower lows and lower highs. And at least for now, it's not, right? So you have a low here, you have a low here, and you have a low here, right? You do have a series of higher lows and higher highs in the HYG, which is a very bullish development. Well, it certainly adds tailwinds to the bullish conversation. So you see this series of lower, higher lows, right, that I just marked in there. You have 1 low, 2 low, 3 low, 4, and 5. If you then take out this low, then that starts to shift the pattern, right? Let me just be a little liberal with this one. I'm going to blend these two together and give you 79. So if this thing falls 45 cents and closes below 79, I think that would be a major red flag for the bull case. For now, this actually gently helps the bulls. At least it doesn't hurt them. Let's go to the VIX next. So one thing that I was talking about in the room today was the potential need for a climax type of selling event. And maybe we got it. However, what I was looking for a climax selling event was going to be a put call, a P call, put call ratio of over 1 and a VIX of 30. Or at least, if not 30, at least a VIX that hits this previous high right here, which is right around 28. The market is significantly lower than where it was, and yet the VIX is still higher back there. So the reason you want kind of this climax event is just because it's kind of like that last puke, right? Like it's just like the last holders, the person that does not want to let go of their shares, they finally cry uncle. They finally buy the puts. They usually do it at the lows. They dump their longs, usually at the lows. They buy puts, usually at the lows. The VIX spikes to 30. The put call goes to 1. And then you have kind of a climax event, especially if you put in a daily reversal candle. We have the daily reversal candle, but we had a daily reversal candle last Friday, right, without the climax event. So just for the sake of completion, it would be good to see that climax event. And again, I'm defining that as, well, I'll give you a couple parameters to define it. 1, put call ratio over 1.0. 2, VIX 28 or higher, ideally 30. 3, a very high volume candle on the SPY and the QQQ daily chart. And 4, a reversal bar. Right, so very similar to what you have today and last Friday. Now, I do want to say this as well, that I've heard the old saying that markets don't usually bottom on a Friday. So that certainly was true last week, and now we're running it back and going to try to do it again. But kind of just something to keep in the back of your mind is maybe markets don't bottom on a Friday, but at least for now, the bulls are punching. What else can we look at here? You know what? Let's go ahead and wrap it there. I think that covers everything, right? I think that there's actually a pretty fine line that we need to walk in this video of giving you exactly just what you need and nothing else, nothing superfluous. I could look at the dollar with you. I could look at 100 different other things, breadth readings, and so on. But I want us to be able to simplify the market in a way that makes it very quick to take action, right? Because what you don't want is to have so much information that you're trying to process it all, and you miss the chance to click the button, right? The only thing that gets us paid as traders is actually taking action, not having this great analysis. So in the spirit of that, I'll go ahead and wrap the video here. Let me just recap the numbers for you. It's going to be SPY 575 in the interim, and the Q is going to be, they'll give you the same level as last week, which is 500. For a climax type of selling event, what I'm looking for is a put call over 1, a VIX of 28 or higher, ideally 30, but 28 or higher, a reversal bar at the lows that happens on high volume, right? That would kind of be a very nice kind of climax event, flush the entire system, and then we can rebuild from there. One last thing here is I do want to draw your attention right back to this chart, and I will say this about my own plan, and you can, choose to take it or leave it. If you see it differently, go ahead and talk to us in the comments down below, or if you're a part of the room, go ahead and send me an email, and I'd love to know how you see it, genuinely. But what I'm seeing here, again, and this is the most important chart in the world to me because it's $15 trillion worth of market cap, is I see down arrows here and a year-long flush. I see up arrows here and a 2-year rally. And now, for the first time since that 2-year rally started, I have a down signal. Doesn't mean the market does this, right? I think everybody kind of assumes that. But it does mean that there is a tenor change, and this time, as opposed to the last times that we've gone into the cloud, this time actually has a little bit of a different tenor. Based on the signal, not on feelings, not on anything else, just based on the cleanliness of the signal. So we'll see if the bulls are able to do something on Monday. Ideally, actually, I think what you'd like to see on Monday is actually maybe an early bit of weakness, or well, early weakness on Monday or Tuesday, right? Like what I would like to see is maybe another quick flush of maybe of the midpoint of today's range, and then a close back above 575, and then we can really start to see if this thing has some traction back to the upside. The path of least resistance based on the chart that's directly in front of you is lower at this point. So personally, even if we do get significant bounces, I will still be looking for spots to short. So I have a very short bias at the moment. I'm happy to be proven by the market that that is the wrong perception. But at least as it sits now, I think we're all collectively hoping for a bounce, even if you're bearish, just so you can get better prices. And if you're bullish, you need the bounce because you need to restabilize the market. So hopefully this helps, guys. Don't be too down on yourself if you found that this market was a little bit complex. I think that happens to everybody. It happens to the best of us. Even some of us on this end of the mic lost a nice chunk of cash this week on utilities, of all things. So like I was telling you guys in the room, and I'll tell you again here on the YouTube, is one major thing from a trading perspective that I think is very important is having the ability to forgive yourself, right? I think that most of us in the trading vocation, we're very type A personalities, right? And we try to, we make a mistake, we maybe stay in a position too long, we ignore our signals, and we kind of beat ourselves up about it, as we probably should. But then after you beat yourself up, say, you know what? I've learned from my mistake. This is what I did wrong. This is what I did well. And learn from it. And as long as you learn from it, you'll make the money right back anyways, right? So just view it as research and development for any mistakes that you've made along the way. And just be okay with missing moves as well, right? One thing is that as markets get more complex and more volatile, understanding what your setup is, and everybody's will be different, understanding what your setup is going to be paramount. So don't go out there and take setups that are not yours, that you don't recognize, that you can't control risk. Just wait for your setup, make sure you control your risk, and click the button. All right, guys, that's my time. Hopefully this was helpful to you, and I'll see you for the next one. Cheers.